How do you rebalance your investment portfolio as your horizon shortens? Imagine you are sailing towards a destination. When you start, you might be willing to take some risks to get there faster. But as you get closer, you want to steer more carefully to avoid capsizing. That's what happens with your investments as your timeline to use the money gets shorter. When your investment horizon shortens, it is time to make some changes to protect your savings. The goal is to reduce the chance of losing money just before you need it. You do this by shifting your investments from riskier assets like stocks to safer ones like bonds and cash. Stocks can grow quickly but can also fall sharply. Bonds and cash are more stable, helping you keep your money safe. The first step is to check what your current investments look like. Count how much is in stocks, bonds, and cash. If you started with 70% in stocks and 30% in bonds, see how much that has changed over time. This helps you know how far your portfolio has drifted from your original plan. Next, decide what your new target allocation should be. Since you are getting closer to needing your money, you want less in stocks and more in bonds or cash. For example, if you had 70% stocks and 30% bonds at the start, you might now aim for 40% stocks and 60% bonds. This makes your portfolio less risky and more stable. Once you know your new targets, figure out what to buy and sell. If stocks have grown and now make up more than your target, you will sell some of those stocks. If bonds are less than you want, you will buy more bonds. This process is called rebalancing. It keeps your investments aligned with your new risk level. You can do this by selling some investments and using the money to buy others. Or, if you are adding new money to your account, direct those contributions into the underweighted assets. This way, you can rebalance without selling too much and paying extra taxes or fees. It is also smart to think about taxes and costs. Selling investments can trigger capital gains taxes, so spreading out your sales or using tax-advantaged accounts can help. Some investors prefer to rebalance gradually over time to avoid big tax hits and transaction fees. Finally, keep checking your portfolio regularly. As your horizon continues to shorten, market movements can change your allocations again. Rebalancing every 6 months or once a year helps you stay on track. This way, your investments remain aligned with your goal of protecting your savings while still allowing some growth. In simple terms, as your deadline gets closer, you want to shift your investments from growth to safety. Review what you have, set new targets, sell what's too much, buy what's too little, and do this regularly. This approach helps you avoid big losses and keeps your money ready for when you need it most.